Welcome back to Curious Commerce. The topic Cash Flow Statement, Part 6. Today we will discuss about the indirect method and adjustments. Most companies in the world do not show actual cash directly. Instead, they start with profit and then discover cash. That approach is called the indirect method. Now let us understand its meaning very simply. What is indirect method? Indirect method is a method of preparing cash flow statement where we start with net profit and then make adjustments to arrive at cash flow from operation activity. So the logic is profit, then we make it as adjustment and we identify the actual cash. That is why it is called indirect. It is not the direct method, it is the indirect method. Under this method, we do not start with cash received. We start with net profit as per profit and loss account. Why? What is the reason? Because companies already prepare profit and loss account. So it becomes convenient to use the same figure and convert profit into cash. For example, net profit of rupees 1 lakh. Now we ask it is equals to cash? Answer is very simple, no. So we adjust it to convert that profit into cash. This is the heart of the indirect method. We should adjust non-cash and non-operating items. We adjust the profit for non-cash items. These affect profit but not cash, like depreciation, provisions for doubtful debts. These are added back because no cash went out. Non-operating items, these are not related to the main business, like profit on sale of asset, loss on sale of machinery, interest received, and dividend received. These are removed from operating profit because they belongs to investing or financing activities. So, an indirect method works like starts with profit, remove fake effects, add back non-cash expenses, adjust with non-business items, and finally reach the real cash. This is the most commonly used method by the big companies, banks. The reason is it matches with accounting records. It is easy to prepare from profit and loss account. And accounting standard prefers this method. So in real corporate world, indirect method is the standard practice. So remember clearly, indirect method starts with net profit. It adjusts non-cash and non-operating items. It is the most commonly used method in practice. Direct method shows cash clearly. Indirect method explains why cash is different from profit. Both together make you a complete finance student. In the indirect method of preparing a cash flow statement, we start up with net profit from the profit and loss account. But profit is calculated using accrual accounting, not actual cash movement. So, we must adjust profit to convert it into cash profit from operations. This adjustment mainly involve non-cash expenses and non-operating gains and losses. Let us understand each adjustment clearly. The step one is add back non-cash expenses. Some expenses reduce accounting profit but not involve actual cash outflow. Since no cash actually left the business, we add them back. The first one is the depreciation. Depreciation is the reduction in asset value over time. For example, the machine cost is 10 lakh rupees, depreciation charged rupees 1 lakh per year. This rupees 1 lakh reduces profit, but no cash is paid now. Cash was paid when the machine was purchased earlier. So we add depreciation back to profit. Second one is amortization. Is similar to depreciation but applies to intangible assets like patents, copyrights, softwares, or the goodwill. Again, it reduces profit but does not involve cash payment now. So it is added back. The third one is loss on sale of assets. Suppose machine book value is rupees 50,000 rupees, sold for rupees 40,000 rupees. The loss is rupees 10,000. This loss reduces profit, but the actual cash received rupees 40,000 is shown in the investing activities, not operating. To avoid double counting, we add back the loss to operating profit. In step second, subtract the non-operating income. Some income increases accounting profit but are not from core business operations. So we remove them. The first one is profit on sale of asset. For example, asset book value is rupees 50,000, sold for rupees 70,000. The profit is 20,000 rupees. Profit increases the net profit, but this income is related to asset sale, not operations. Cash from sale goes under investing activities, so we subtract the profit from the operating profit. The second one is non-operating incomes. These include income not related to the normal business activities such as interest income, dividend income, profit from investment, and rent received, if not in the main business. These increase profit but are not operating cash flows, so they are subtracted. The simple logic to remember, did cash actually move because of this item? If no cash moved or if cash belongs to investing or financing activity, adjust the profit. Adjustment summary table. So the adjustment type is the depreciation, the treatment is add back. The reason for that is no cash outflows. Amortization is once again the same thing. It is the add back. that is the treatment for that, and the reason is no cash outflows. It is just like the depreciation. Third one is loss on asset sale. Let's add back. The reason is loss already reduced profit. Fourth one is profit on sale, profit on asset sale. That is subtract. The income is not operational, so that's why that is the reason we should subtract it. And non-operating income, once again it is subtracted because not business operations. The final understanding related to the indirect method is accounting profit leads to actual operating cash flow by adding back on non-cash expenses and removing non-operating gains. Thank you for watching. Subscribe to Curious Commerce. Follow our WhatsApp channel Curious Commerce Financial Management Hub for daily finance learning. The topic cash flow continue in part 7.